The DeepSeek news did its best to push us into a market crash, but the fact remains that artificial intelligence is the future. And more than that, DeepSeek actually speeds that future into view. Hey Bowtie Nation, Joseph Hogue here with a video a lot of you have been requesting since last month's news, because as we saw with the $600 billion loss from NVIDIA's valuation, not all AI stocks are going to be safe as that future evolves. I'm going to show you why that DeepSeek news is actually a good thing for the AI investing theme. Then reveal my 5 favorite AI stocks, 5 dominating their piece of the data center ecosystem, counting down to the one AI stock every investor needs to own. Founded just 2 years ago in 2023 and just released, Chinese AI firm DeepSeek unveiled an open source model that performs competitively with leading models like ChatGPT and Anthropic's Claude. The shock here was that DeepSeek was able to create its R1 model on just $5.6 million, a fraction of the $100 million cost OpenAI spent to train its newest GPT-4 model. And DeepSeek was able to do it all without the use of NVIDIA's most powerful chips. Now, of course, that is a huge problem for NVIDIA and the AI hardware companies, because to now the thinking has been that you've got to be spending tens of billions of dollars on the fastest, most advanced semiconductors and then running massive amounts of compute power to train those AI models. If that assumption is called into question now, it puts in doubt the 112% revenue growth to $130 billion expected for NVIDIA this year, and that stratospheric valuation investors are paying for it. And now, besides the question whether DeepSeek's claims are even legitimate, which that claim is already misleading because its $5.6 million reported excludes costs for research, experiments, architectures, and algorithms, but assuming that higher efficiency in model training has been achieved, it could actually turn out to be a driving force to more growth and spending in AI. Analysts at Bernstein point out that according to the Jevons paradox, that often efficiency drives more demand because as those costs come down, it allows more companies to compete and innovate, and in the end, increased consumer usage is more than enough to take up that new capacity, i.e. in human terms, that while some AI models may be able to do more with less, the use case in AI is so enormous, that demand is so big that at this point, we're still going to need all the high-powered chips and all the data center compute power that we can create. And Goldman Sachs reiterates this and says that it could accelerate the shift from model training to inference, which requires less intensive compute, but drives more use cases and more demand. And news recently from Microsoft, Amazon, and Meta reaffirmed those AI spending plans, with Microsoft talking up long-term investments and Zuckerberg affirming a $60 billion plus budget this year. And if that data center infrastructure boom is still on, JP Morgan estimates it could draw upwards of $1 trillion through 2027 just from the 5 major hyperscalers. So nation, that AI stock theme is still very much on, but what last month's news does remind us is that valuations still matter and that it's not just about buying NVIDIA. Where the AI investment theme has been a one-way ticket over the past 2 years, where investors could basically just throw a dart at a list of AI stocks and make money, we're now faced with a decision. Which are going to be the AI stocks that dominate their industries and outperform? For that, we need to dig into the critical components of a data center, from servers and storage to networking, finding the one stock to buy in each component. First up, networking, which is a critical connection within the data center for high-speed data transfers between storage, servers, and external networks. For AI workloads, InfiniBand and high-speed Ethernet of at least 400 gigabits per second are critical to handling that massive data exchange between GPU and server. The networking market just for data centers is expected to grow at a 15% annual pace from $34 billion in 2023 to over $92 billion by 2030, according to Grandview Research. But here in the networking component, I'm torn between Arista Networks, ticker ANET, with its growth and AI focused, versus Cisco Systems, ticker CSCO, which is the underappreciated value play. Arista specializes in the kind of high-speed, low-latency networking that AI data centers need. Its EOS software is a key differentiator, offering better programmability, automation, and scalability compared to Cisco's legacy systems. Arista's 400G and 800 series Ethernet switches built on merchant silicon are widely used by the hyperscalers like Microsoft and Meta. But then while Cisco may not have that AI-specific focus, it has a more diversified portfolio, including networking, security, and data center management, and can provide that kind of end-to-end infrastructure solution, integrating networking with compute and storage in a way that Arista just cannot. So here, if you're looking for growth, and really that's what we're talking about here in the AI theme, then Arista has the clear edge, and sales expected up 19% this year to $8.3 billion. But you are going to pay for that growth, with shares trading very expensively at 21 times on a price-to-sales basis. So So on that kind of a valuation, you're always going to be at risk to just one bad headline like DeepSeek or some other news pulling the rug out from under the stock. On the other hand, Cisco's growth of just 4.3% this year to $56 billion may be underestimated, and the shares trade very cheaply here at 4.7 times on that price to sales. A major slowdown in data center growth or the AI theme would still hit these shares, but barring that apocalypse scenario, the slow and steady play here would be in Cisco. We're just getting started on our list of AI stocks, but if you've ever wondered what's in my portfolio or want to see the stocks I'm buying, you can by joining me on the Blossom Social Investing app. The app was created by investors and for investors. I just started using it last year and love it for getting ideas and sharing my portfolio. And this isn't just another social app. You can connect your brokerage accounts or just input your portfolio to track all your stocks in one place. You're going to see insights like portfolio percentages and average dividend yield across the entire group. You'll also be able to join more than 200,000 investors in a social feed to see what everyone is talking about. Now, I've shared my portfolio on the app, and it's totally free to download, so look for the special invite link I'll leave in the description and check that out. Storage within data centers means holding everything from raw datasets to trained AI models, with competition in the space between direct attached storage, network attached, and storage area networks, with those SANs really the best for that high-speed connectivity and low latency needed, so focus on the providers specializing in that space. Research and Markets estimates the data center side of the storage market at just under $124 billion, growing to $354 billion by the end of the decade, a 16.2% annualized rate. And here, trillion-dollar Broadcom, ticker AVGO, plays in several of the data center areas that we'll talk about, but it's the company's advantage in AI-focused storage in its SAN space that really highlight here. The company's Tomahawk and Jericho series of Ethernet switches offer industry-leading bandwidth and efficiency, along with low latency, and the company is also competing in chips with its application-specific integrated circuits, but it's Broadcom's storage area network solutions that really dominate its industry, with adapters and switches for high-speed, lossless transfer between storage and resources. Growth of 18% this year is expected to take the company to $61 billion in revenue and $6.35 in per-share earnings. Broadcom is one of the most expensive stocks on the list, though, trading at 20 times its revenue, and even on this year's growth at 17 times on that price-to-sales basis. I do like the company's leadership in several core data center components, but I might wait for the shares to come down a little bit to add this one. Next, if you're on a laptop, check how hot the back of it is. Now imagine tens of thousands of those in a data center, and you start to get an idea of how important cooling is here. AI and its high-density workloads generate a huge amount of heat. Now, air-based cooling used to be the norm, but liquid cooling, either direct-to-chip or immersion cooling, is really gaining traction. The cooling systems market alone is smaller at just $17 billion, but expected to see that same solid growth we see in these other data center components, around 17% annualized through 2030. Vertiv Holdings, ticker VRT, is really as close to a pure play here for its power and thermal management solutions and is expanding capabilities through acquisitions. This company is also a player in the power management space that we'll talk about next, but gets about 30% of its business in cooling, with the air cooling market expected to grow at a 70% pace and liquid cooling at a 30% pace. Vertiv is a critical partner with NVIDIA, co-developing its cooling platform using up to 40% less space and a 20% reduction in cost. Last year, revenue was up 14%, along with an increase to 19% on operating profitability and reaching $1 billion in free cash flow. That revenue growth is expected to accelerate this year, up 18% to over $9 billion, and with a 32% jump in earnings. That's going to put the shares at a price of 4.5 times this year's revenue from the current 5.7 times multiple. That's still a premium on that long-term average, but not expensive for a company growing nearly 20% a year. Power to data centers has to be continuous, reliable, and above all, uninterruptible. Any interruption, even for a fraction of a second, can mean data loss, model corruption, or even a system crash. That's why even the centers that use some form of renewable energy, like solar and wind, are built on redundant systems and backups. Artificial intelligence is expected to drive a 160% increase in power demand through 2030, consuming more than 1,000 terawatt hours per year, an annualized rate of 14% according to Goldman Sachs. Bloom Energy, ticker BE, has designed a distributed generation platform that is reliable and scalable to data center needs. The solid oxide cell technology converts fuel into electricity without combustion and can be stacked into modules to provide data center power without outage risk. The platform is being used across the industry, including by Equinix, the largest publicly traded data center REIT. Now, growth here is a little slower, but still a strong 20% this year to $1.7 billion, and with earnings expected to jump more than 500% to 44 cents a share. Valuation is higher than it's been at 4 times on a price-to-sales basis, well above the 2 times multiple it's averaged in the past. But the theme means this could grow into that valuation and beyond. I'm going to highlight that one AI stock I'm buying above all the rest next, but that DeepSeek news does put some risk into this whole theme. You might not get rich off dividend stocks, but one thing you will do is smooth out your portfolio and give you the cash to reinvest when stocks fall. So check out this video next, the 12 dividend stock portfolio that'll put cash in your pocket every single week. Now, if you imagine semiconductor chips as the thinking power of an electronic device processing that information, then servers, which hold those chips, are like the brains of a data center. These are the workhorses of the center, training AI models, then used in inference to run the models. The server market at around $84 billion in 2023 is expected to see slower growth, but still nearly 13% pace to $200 billion by 2030, and competitive leaders are going to see even faster growth. A supermicrocomputer, ticker SMCI, would be the easy pick here with its modular designs that enable data centers to customize and change out their components, and is one I'm also buying. But I think the best opportunity in data center demand, the one I'm buying above all the rest, is Advanced Micro Devices, ticker AMD. And I know AMD reported a supremely disappointing Q4 earnings last week that saw the shares crushed 10% on the day. Except it really didn't. Wall Street was disappointed that the chipmaker reported only $3.86 billion in sales to data centers, under analyst expectations for $4.1 billion over the 3 months. But if you look at the rest of the report, it was anything but disappointing. Both top-line revenue and earnings beat analyst expectations, with a 40% jump in overall sales to $7.6 billion in the quarter. PC and laptop revenue, which is in a down cycle for demand right now, grew at a 58% pace with stronger market share wins against Intel. Even in that all-important data center segment, revenue increased 69% in the quarter. Yes, Nvidia has dominated the chip market for AI training for its advantage in that edge computing, but the shortage, along with rumored overheating problems in its new Blackwell chips, has pushed prices skyward. Nvidia GPUs cost upwards of $25,000 each, and we're hearing lately of more hyperscalers shifting to AMD for its less expensive chips. AMD's M1300 series, especially the 350 upgrade launching this year, is going to feature a 35 times performance increase. It's very competitive with NVIDIA's Hopper H100 chips for inference benchmarks. Dell recently announced it would be using AMD chips for corporate customers for the first time, where it had previously only used AMD for consumer PCs. IBM has also said it would be using the AMD 300 series in its cloud services starting in the first half of the year. So despite the disappointing sales, this is still a strong growth stock, expected to post a 23% increase in revenue to $32 billion this year and 22% next. And so here, really it just comes down to valuation and patience. The same kind of valuation and patience we saw when I said to invest in SoFi Technologies back in late 2023, around $5 a share. It did take a while for that valuation to prove right, and many didn't have the patience for it. But that stock is now up 200% in less than 18 months. After that sell-off last week, AMD is a $174 billion company and trading for a price of just 5.4 times this year's expected sales. Even back to that 7.6 times price-to-sales multiple, which was really low compared to the 8 or 10 times average, even that would be a 40% return from here. So that fair value on this stock is at least $150 a share and higher as that 20% plus annual growth keeps running. Join me on the Blossom Investing app and see what over 200,000 investors are talking about with the special invite link below. Or click on the video to the right to see that 12-stock portfolio that sends you a dividend your way every single week. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.